Let's talk about global debt, the money borrowed by governments, companies, and yes, you with your credit cards. Right now, global debt is over $300 trillion. That's 3 times the size of the entire world economy. Imagine the global economy as a giant Jenga tower, each block alone. When things are good, we keep stacking higher. But if interest rates rise or economies slow, pulling out, a block can make the whole tower wobble, or collapse. Governments borrow for roads, hospitals, and sometimes things they don't need. Companies borrow to grow. The problem? Borrowing has gotten out of hand and the bill is coming due. This isn't just economist talk. Debt shapes what governments can spend, how stable your job is, and even the price of bread. It's the invisible force shaping our lives, and lately, it's looking more like a clenched fist than a helping hand. The world's debt binge is catching up with us, and the consequences are real. Not all debt is created equal. Economists use the debt-to-GDP ratio to see if a country's debt is manageable. Japan's ratio is over 260%. It owes more than twice what its economy produces in a year. But most of that debt is owed to its own citizens, so it's stable for now. The US sits at about 130%. It can borrow easily because the world wants dollars, but even that has limits. Germany, the model of fiscal discipline, keeps its ratio around 65%. Boring, but safe. For developing countries, even a lower ratio can be dangerous. Ghana's 85% is riskier than America's 130% because it borrows in foreign currencies and has a smaller, less stable economy. It's like a millionaire owing $100,000 versus someone on minimum wage owing $10,000. The pain is much greater for the latter. The numbers may look abstract, but the risk is real. High debt can mean economic pain, especially for the most vulnerable. The higher the ratio, the shakier the ground, and the world's ratios are rising. That's a warning sign. The most at-risk countries are those with high debt, low income, and unstable politics. They can't print dollars, so they borrow in foreign currencies, making them vulnerable when global interest rates rise. Sri Lanka, Ghana, and Zambia have all faced crises when they couldn't pay their debts, leading to shortages and chaos. A strong dollar makes their debt even harder to repay overnight. Many struggle to collect taxes, so they must choose between paying creditors or funding schools and hospitals. China has become a major lender, sometimes taking control of assets when countries can't pay. For these nations, debt isn't just numbers, it's survival. They're caught in a web of economics and geopolitics, often with little power. The stakes couldn't be higher. You might think, why should I care? But global debt crises don't stay contained. They spread fast. A default in one country can trigger panic and financial turmoil worldwide. High national debt can mean government spending cuts and higher taxes for you. Risky borrowers see their currencies weaken, making imports and everyday goods more expensive. Inflation hits everyone. Some countries like Switzerland and Scandinavia show it's possible to manage debt responsibly and still provide a good life. But most of the world is walking a financial tightrope. Global debt is a promise to the future, a promise we may not keep. Ignoring it won't make it go away. When the system breaks, there's no easy fix, and we're all in this together.